today what I wanted to cover, and it's something that we emphasize a lot in our chat room and Trade with Tex, is candlesticks, right? So for the most part, candlesticks are very similar to bars. A lot of you guys probably were introduced to stock charts or futures or options, whatever you really trade, using one of the two. But personally, I prefer candlesticks. I'll show you exactly why. And we're really going to get into the basics. We're also going to talk about supply and demand briefly. It's kind of an economic concept that applies to really everything that we do. And then we're going to talk about one candlestick trading strategy. I know we mentioned that we were going to cover three, but just from a time standpoint, I know you guys have families, have friends, you have things to do. You want to kick back and relax at the end of the day. So we're going to keep it nice, short, and sweet, and cover one strategy instead of the three. And we're going to cover those strategies, the remaining two, in another webinar. All right, we're going to break it up a little bit, but let's jump right into it. Okay, so as I mentioned, I'm a pretty active trader. So what I really look for are technical setups that have good risk to reward, right? It's a pretty, simple concept that a lot of you guys probably already apply to your investing style already. But a lot of the trades that I take that have a good risk to reward are based off of how these stocks are reacting just in terms of price action. And the reasons why candlesticks give you such a good idea of price action and really help you enter and exit at the right times are because of a simple concept of supply and demand. Okay, and I'm going to pull up a picture right here in the background to give you a better idea of what I'm talking about. So these are the Candlestick Basics. It's just a little image that I threw together here. And supply and demand applies to everything that we do on a daily basis. And more specifically, it applies to the price, right? So supply and demand from a simple standpoint just shows you how many sellers, right, supply, or how many buyers there are to determine what kind of ending price that we're going to get at the end of the time frame that you're looking at. So at the end of a 5-minute period or a daily period, whatever it may be. And that's what's so awesome about candlesticks. Actually, if you read into the history of them, they've been around for hundreds and hundreds of years. Because back when they first started trading things in Japan, this is where the concept emerged, right? Just applying basic supply and demand to kind of gauge what prices were fair and what prices were unfair. Okay, so again, a simple concept here of supply is just to think of it as sellers, okay, and demand is just buying pressure. So buyers in that sense, right? Now, candlesticks, we'll start off with just a basic green candlestick here to give you an idea of how they work. I'm sure a lot of you guys already know this because you have trading experience, especially my members that are in here. We use this on a much more advanced scale daily. So you're probably already used to this, but just as a little refresher, let's go over the basics here, okay? Now, for a green candle, right, what we have here are two different parts, and there are a lot of little labels, so I'll try to separate them and keep it nice and simple, right? First part here is the body, and that's the open and closing price. So if it's a green candle, the open is the lower line here, and the close is up here. Okay, if it's a red candle, it's just flipped, right? Where we opened up here and we closed down here. All right, the second part, other than the body, and I guess technically it's a second and a third, but it's the shadows, right? The upper and lower shadows. These are also commonly referred to as wicks, right? I like calling them shadows, but it's just based off of personal preference. It's the same concept, okay? Now, the shadows show you the range, right? So the total range of a stock. So let's say a stock traded between $50 per share and $60 per share on the day. This is the total range, right? It's a $10 difference here. Okay, now the upper shadow refers to this guy right up here, okay, and the lower, this one. So what that's showing you is the lowest price that it downticked to on the day and the highest price that it upticked to on the day. And the reason why these are so noteworthy is because it really shows you where bulls and bears fought, right? The close always gives you a good idea, and obviously the open, of where there are buyers and where there are sellers, right? Because, for example, if you're a technical trader, you know that if a stock closes above a resistance level, then it's breaking out. It's giving you a buy signal, okay? It's a pretty common thing. It's a pretty simple thing, right? And if we're closing below support, it's breaking down. Sellers are taking control. So when we have these wicks or these shadows, right? They give you a good idea, in this case, the lower shadow, where buyers stepped in. So where the demand is, what prices people are willing to pay for the stock. And the upper shadow shows you where the sellers were. Okay, that's an easy way to kind of think of it. All right. Now, obviously, if it's a green candle and we close higher, you can see that buyers won this fight, right? Bulls won this fight. I always like to think of it as bulls versus bears. If we close lower, then bears won the fight. And that's a very simple way to think about these candlesticks. Okay. So, for example, if we have a candlestick that has a very large upper shadow, even if it closes green, right? Even if we do see that bulls won the fight, it still shows a tremendous amount of selling pressure, right? A tremendous amount of supply, all right, in this case. So I want to get into a couple of basic candlesticks that you'll probably see, on a daily basis. And I got the picture right here to pull up. We're only going to go over a couple of these just because I feel like it's a lot of information. And for me, I'm a visual learner, and I kind of try to absorb as much as I can. But personally, I think going over every single little thing is information overload, right? So the few that I want to go over, we'll talk about this guy right here, this one, and also this one. Okay, so what we're really looking at each candlestick as is a basic supply and demand concept, a basic bears versus bulls, right? If there's an oversupply, if there are a lot of bears, if there are a lot of sellers, then the stock is likely going to close lower, right? If there's a lot of demand, then the stock is likely going to close higher, okay? But being able to look at the shadows along with the body, right? Being able to just dissect those very two basic points of a candle give you a good idea of where we're going. So in this case, this candle actually doesn't look that bullish at a glance, and this is kind of the tricky one here. We're going to talk about this extensively. It's a hammer, right? That's the strategy that we're going to go over. But the reason why it doesn't look bullish is at a glance, you probably think, well, there's not really a big green body here. We barely closed higher for this time period, right? And bottom line, right, there was a lot of sell pressure at one point. But the way that you're supposed to think of this and the way that you would interpret this is essentially just by saying that, yes, we did open right here and then close higher. So bulls technically won the fight. Okay. And on top of that, even though we dipped down substantially, this right here shows excess demand, right? Shows a lot of buying pressure. Shows that everybody stepped in and defended the stock here. So it's very likely to reverse and go higher after this type of a candlestick. Okay, what we have on the next one here is just a very normal bullish candle. It's kind of simple in the sense that you can see where we opened, where we closed higher, and there's neither a big shadow on either end, right? If this one was large, then we would see some supply. We would see some sellers here, okay? If this one was larger, then this would be a much, much more bullish candle because it shows that buyer stepped in and defended it, okay? But this is just a standard bullish candle, okay? And I wanted to also go over just a neutral bullish here because this is just an indecisive candle. And the reason why we're having this webinar is so you can get a read on price action. I find a lot of times, especially with educational services, like for example, Trade with Tex gives alerts and we talk about the educational side of things pretty extensively, right? And I feel like a lot of the different chat rooms out there don't really give you an idea of price action. And this is the easiest way to get a handle on it. Because if I'm looking at a stock intraday, right, and I see it form this kind of a candlestick, then I know it's very likely to go up afterwards. I know that's meaningful. If I see a neutral candlestick like this one, where we have an even upper shadow and a lower shadow, right, upper and lower, and then we just barely closed higher, you don't really think too much of that. That's not going to reverse the trend. And personally, if I'm holding this stock, right, if I have shares of this, I'm long, I bought some, then I'm probably not going to get scared out here. I'm not going to change my plan at all. I'm just going to stick to it because this is showing that the current trend is going to continue. It's just neutral, okay? So what you want to do is use this as an educational tool in your trading to see what is meaningful and what is meaningless. In this case, meaningless, meaningless, meaningful. And that's why we're going to talk about the hammer more extensively. Okay, so this, if we're in a bullish trend, would just show that we're going to continue, and same thing with this guy here. All right, Now, with regards to a hammer, I do want to use an example here and just dive right into this first strategy because this is what I mainly want to talk about. And again, if I am breezing through this kind of quickly, I know your time is valuable, and we do have plenty of other videos, not only on the Speed Trader YouTube channel, but also on the Trade with Tex YouTube channel, right? And you can also email me if you have questions as well. But for the hammer trading strategy, it's actually pretty simple. And the way I kind of want to break it down is using an actual chart here. So we're using a very basic Thinkorswim chart. I do personally use Speed Trader for trading. This is just a simpler way to look at it. But if you're using an actual platform, I highly recommend using a DOS platform. Okay, it's a lot more complex and it's a lot more advanced than what we're using here. But this is a daily chart for the NASDAQ. So we're looking at futures, and if you don't know what futures are, that's fine. But this is just the best example that I could find for this. So really, we're looking at the NASDAQ index. If you've ever invested before, you should have a feel for what that is. If you don't know what that is and you are investing, stop, take a break and learn something first, okay? But the NASDAQ index is one of the biggest ones out there and one of the most widely used ones. What we're looking at right now is the 1 year, 1 day chart. Okay, so essentially this time frame is very commonly used. Even though I'm a day trader, I use this for support and resistance levels, and I use it to get a feel for what kind of price action we're getting and what we should expect for the next day. So whenever we close down a day, let's say I traded Apple today. Apple's, a NASDAQ stock. I'll check to see what the NASDAQ daily candle was, right? Each one of these candles represents 1 day to get a feel for what to expect tomorrow. So obviously, if we were to just glance at today's daily candle, so this is 1 day over the past year, if we were to zoom in and glance at today's, we can see that it was slightly bullish, right? Just because we opened here, we closed here, and there was no big upper or lower shadow. So we actually just finished talking about this in chat, and we talked about how this was essentially a neutral and meaningless candle, but it was technically bullish, okay? Now, I want to point out the hammer here. And hammers aren't really the easiest to spot. That's kind of the tricky part about candlestick formations. But once you spot one and once you get a signal for one, it's clean cut, straight to the point. You know when to buy, you know when to sell. Okay. Now, a hammer is technically defined by the body of the candle being at least twice that of the shadow, of the lower shadow. So what that means, and this is the one that we're referring to here, is that this body, right? Actually, sorry, the shadow is double that. I said that incorrectly. The shadow is double that of the body. Okay. So this body, as you can see, if we were to double or even triple it in size, it still wouldn't even measure up to that huge lower shadow. And what that shows us is a lot of buying pressure. Okay. So in this case here, for this hammer, you can see that we ended up opening and then closing higher, right? So it's a green candle, and it fits the criteria because we have this enormous lower shadow. Now, one thing I want to point out here is that you need a downtrend prior to a hammer in order to utilize it. Why? Because this is a reversal strategy. So you're only going to use it for bounces. Okay? Now, spotting the hammer is just part of it. And the way that you do that is simply by saying, okay, this body is smaller than lower shadow, right? Now I've spotted this hammer. Now I can utilize it in my trading, right? I can wait for the signal. The actual signal here is pretty simple. Okay, so let's backtrack real quick just for half a second. We have a drop from the NASDAQ over the course of 1, 2, 3, 4 days. We're in a short-term bearish trend. It's pretty clear there. Okay, now we get this hammer and it's signaling a move up, but you don't actually buy it just because the hammer exists. That's a horrible way to trade. What you need to confirm it is price. That's what's going to confirm your signal. That's what formed the hammer in the first place, right? It showed that we had all of these buyers down here and really barely any sell pressure. Okay, so price in the first place is what put this on your radar, and that's exactly what's going to confirm the trade. Now, the thing that signals the buy is simple. It's just a break of the high. Not of this entire chart, of that hammer. Okay, so all we need to do is draw up the high here. So that is 7062.5. And I'll just draw that quickly here. Actually, 7062.5. I think I misspoke there. All right. And all we need is for a break of that level in order to give us a buy signal. So we can zoom it in to whatever time frame you use short term. So again, we're using the daily chart for the idea. We zoom it in. Let's say you use the 5 minute. That's a pretty common one. That's what we use in our chat room. You can see that this was the level that we were looking at, right here. And the opening bell was on Monday. And as you can see, we actually opened up above the resistance. So we know that we're in a breakout mode today. And you can see the action that we got on Monday. This was the opening bell. This was the level that we needed to hold above. So we rang that opening bell and we were good to go. Huge move to the upside all of Monday. And we ended up closing at the high, right? If we go back to that daily chart, there's the hammer breakout. And you can see just how powerful that candle was. Right, we ripped higher the entire day. All right, and that's how you utilize a hammer. So again, the way to spot it is just by finding a candlestick that has twice the lower shadow as it does the body. Okay, so you need to understand those two concepts in order to apply that to your trading. And then the signal is just a break of the high. And you have to wait for that price to break and hold before you buy. All right. It applies to stocks. It applies to futures. It applies to pretty much everything, right? As I mentioned, supply and demand goes hundreds and hundreds of years back. These Japanese candlesticks go hundreds and hundreds of years back. And it applies to everything that we do. So basic supply and demand, it shows you where to buy, where to sell, and that's it. All right. So if you guys have any questions on candlesticks, supply and demand, or the hammer trading strategy, feel free to let me know. Just keep in mind that if you're using these hammers, right, you're using them on bigger time frames. A 1 minute hammer doesn't mean crap, doesn't mean anything. You're wanting to use these bigger time frames because they signal bigger moves. So in this case, I used the 1 year, 1 day to spot it. All right. Okay, so if you guys have any questions, you can let me know. If not, you can feel free to email me at sleemstockanalysis@gmail.com. Or just visit the Trade with Tex website and contact me through there. So that's tradewithtex.com. Okay, but thank you so much, guys, for your time. I appreciate it. And Don, I'm going to turn it back to you.
Well, there you have it. First lesson in candlesticks. Very, very important for traders, obviously. We're looking forward to doing a lot more of these with Faris. He's just a wealth of knowledge, and a lot of people find a lot of value in him. Again, should you have any questions towards Speed Trader, you can email me directly, D Hensley, that's H-E-N as in Nancy, S as in Sam, L-E-Y, @stockusa.com. Other than that, as per usual, I wish you the very best of luck in the markets. Take care.